Hi everyone. In this presentation we're going to explore the accounting cycle. Alright, well what is the accounting cycle? Well, it's given right here in cell E2, and I like to use Excel as a nice background since Excel is the accountant's best friend. It's usually the favorite tool of choice. Alright, so the accounting cycle is the sequence of activities beginning with the occurrence of a transaction, and it flows through all the steps of the accounting process. Okay, let's go over those steps. The first one is identify the transaction. That's where we identify an event as a transaction and we generate the source document. Next, we analyze the transaction. Here we determine the transaction amount, which accounts are affected, and in which direction. And I think we need a D right here. Next, we prepare journal entries. We record the transaction in the journal as a debit and a credit. And then at step 4, we post to the ledger. The journal entries are transferred to the appropriate T account in the ledger. Now step 5 in the accounting cycle is preparing the trial balance. The trial balance is calculated to verify that the sum of the debits are equal to the sum of the credits. At step 6, we explore adjusting entries. We make adjusting entries for accrued and deferred items. The entries are journalized and posted to the T accounts in the ledger. Okay, at step 7, we put together an adjusted trial balance. And a new trial balance is calculated after making the adjusting entries. At step 8, we prepare the financial statements. At step 9, we perform closing entries where we transfer the balance of the temporary accounts, and those are the revenue and expense accounts, to stockholders' equity. And then finally, step 10, we prepare a post-closing trial balance, which is a final trial balance that gets calculated after our closing entries are made. Okay, now let me move that off the screen. Those are the steps of the accounting cycle. Now we'll look at each step individually. So the first step is to identify the transaction. We identify an event as a transaction and we generate the source documents. Let me move this off the screen. Up. Move this out of the way. Okay. Now, events have a financial impact on the business. Events also can be readily measured. And I'm following right here. Right? There's two sides, a giving and receiving side, and both sides of the transaction will be recorded. Now, I'll give you a couple examples. An external transaction would be, say, where we purchase goods or services from someone else. Could be supplies, inventory for resale, health insurance, general insurance. Another example of an external transaction would be where we have a sale of goods or services to our customers. We also could have internal transactions. We could be transferring raw materials from the warehouse to the factory at the start of production. We could be transferring finished goods from the factory to the shipping warehouse when the goods have been completed, and perhaps we're completing a maintenance work order on a piece of equipment. These are just examples of internal transactions. That's step 1. Let's look at step 2. Okay, step 2 says we analyze the transaction. We determine the transaction amount, and which accounts are affected in what direction. Okay. So we would figure out which accounts are increased and which accounts are decreased. That's part of how we analyze a transaction. Then at step 3, we would record the transaction in the journal entry. So let's first look at an example where we purchase supplies on account for $3,500. we would debit supplies, which increases the asset, right, a current asset, which increases supplies for $3,500, and we would accredit accounts payable, which is a current liability that's used to represent the obligations we owe to our vendors in exchange for either goods or services that they've provided now, and of course we've agreed to pay for them in the future. So our obligation to pay those off shows up in accounts payable, and we're crediting a liability, so we're increasing the account. Okay, so that's one way we would record the transaction in a journal. Now, what if we were to sell merchandise costing $4,000 for $5,000? Well, we actually have two entries here. We would debit cash because we received cash for the merchandise we sold, and we would credit our sales account or our sales revenue account. Both of those would be increased because cash is an asset. Assets increase with debits. We increase sales revenue because revenue is part of stockholders' equity that increases with a credit, right? Now the other half of the transaction is where we debit cost of goods sold, increasing cost of goods sold, and crediting inventory. In other words, at the point we have a sale, we no longer own the inventory, so our asset, the inventory account, has to decrease, and the offset goes to cost of goods sold. And those are in the amount of $4,000 because that was the cost value of what we sold. Okay, that's an example of step 3 of the accounting cycle where we will prepare the journal entries. Now, after we prepare the journal entries, we've got to transfer them to the appropriate T accounts. So let's look at this example that you see on your screen now. When we purchased supplies on account for $3,500, we debited supplies, which increased them, and we credited accounts payable, which also increased accounts payable. Now here we've got an example of the supplies account. It's a T account, right? We show it as a T with debits on the left, credits on the right, and we've got accounts payable shown as a T account with debits on the left, credits on the right, and here we've credited accounts payable. Okay, so for these two entries, here's how we show the journal entry is transferred to the ledger, and we're using T accounts to represent just two accounts in the ledger. Keep in mind that all of the accounts combined make up the accounts in the general ledger, so you can think of it as all the accounts make up the general ledger. Now, what if instead we sold merchandise costing $4,000 for $5,000? The transaction just we went through. Well, we would have a debit and a credit and another debit and credit, right? Debit for cash, credit for sales at $5,000. Then we debit cost of goods sold to show that it's an expired cost, and cost of goods sold is an expense that appears on the income statement, and we credit inventory showing us that we no longer own the inventory because we sold it to our customers. So here, let me slide down. We've got 4 T accounts that we have to use to show posting to the ledger. So I'm going to expect to see a debit of $5,000 of cash. I see it there. A credit to sales revenue. I see it there in our general ledger, or if you will, the accounts that make up the ledger. A debit to cost of goods sold for $4,000 and a credit to inventory of $4,000. Oh, by the way, that should say $4,000. That should not be $5,000. That's a key punch error on my part. Okay, next we prepare the trial balance. It's calculated to verify that the sum of the debits are equal to the sum of the credits. So here's an example of a trial balance for sample company. All it does is list the accounts and their balances, gives us a total. The debits should equal the credits. If they don't, an error has been made because we always have to stay in balance. And we show the balances for each account. And just as we would expect, the assets have debit balances, the liabilities retained and stockholders' equity or owner's equity section have credit balances, and the expenses have debit balances. Okay, that's the trial balance step. Next we look at the adjusting entries. Now, once we've prepared the trial balance, before we can prepare financial statements, we have to perform adjusting entries. And adjusting entries usually take place as one of the last items that we do before the period ends, before we equal financial statements, but we usually don't perform the adjusting entries until it's late in the period where we have the information we need to come up with proper adjusting entries or good estimates. Okay, adjusting entries are made for accruals and deferred items, and they're journalized and posted to the T accounts in the ledger. So let me give you an example. Let's assume we originally purchased prepaid insurance on 10/1/2014 in the amount of $12,000, and we'll assume it's a one-year policy. We would have debited the asset account prepaid insurance. That's a current asset because it has future value at the time we purchased it. In other words, it's insurance that we have available for our use for the next year. But at 12/31/2014, we want to prepare annual financial statements, so we have to show that a portion of it has expired. Well, if it runs from 10/1/2014 to 9/30/2015, we know that 1/4 of it is expired. So 1/4 of $12,000 is $3,000. So we're going to make an adjustment where we debit insurance expense, therefore increasing the expense by $3,000 and crediting the prepaid insurance. And we have to make that entry so that both our expenses and our assets are stated correctly. There are other adjusting entries we would have to make too to make sure liabilities and revenue are stated correctly as well. Okay, after step 6, we move on to the adjusted trial balance. Now, the adjusted trial balance is where we prepare a new balance, and it's calculated after making the adjusting entries. All right, so let me slide this off the screen. And here's an example for sample company of a trial balance. Now, we actually started off with an unadjusted balance, and then we made adjustments, and then the debits and credits that we see at the end is really the adjusted trial balance. Now, sometimes that's all you'll see. You won't see an unadjusted balances or adjustments column, but I wanted to present it this way to show you how the flow works. We would start off with unadjusted balance. We'd make our adjustments really earlier on in our accounting cycle, and then once we get to step 7, we would prepare the adjusted trial balance. Now, in our example, I only had one adjustment, right? The adjustment for insurance expense and prepaid insurance. Now, keep in mind, for a company, not just this particular example, there would be many more adjustments than just an adjustment of prepaid insurance. Okay, after we prepare the adjusted trial balance, now we're ready to prepare the financial statements, and we rely on the adjusted trial balance to put it together. Let me slide this off the screen for you. Okay, now we're going to put together 4 financial statements. These are the primary financial statements, and we put them together in this order: the income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flow. The reason we put them together in that order is the financial statements are interrelated. We need information on the income statement to flow to the statement of stockholders' equity. Then we need information on the statement of stockholders' equity to flow to the balance sheet. And we also need information on the balance sheet to flow to statement of cash flows. Okay, so the first one we prepare is the income statement right here. You see it ends with a net income of $35,500. If I bring the statement of stockholders' equity forward, so we can see all of it, we see that $35,500 from the net income did appear on the statement of stockholders' equity. And the statement of stockholders' equity is a reconciliation type report. It starts off with a beginning balance. It shows you what increased, what decreased, and comes up with an ending balance. And we certainly needed net income to come up with the ending retained earnings number. And we're going to need that $100,000 of capital stock ending balance and $135,700 of retained earnings to flow through the next statement that we would prepare, which is the balance sheet. So let me bring that one to front so we can see all of the balance sheet now. And sure enough, we see that $100,000 of capital stock and $135,700 making its way from the statement of stockholders' equity now to the balance sheet. Okay, now let me slide this up a little bit because I think I was going off the screen, so that was hard for you to see. There's the 100 and the 135. And like all balance sheets, the debits have to equal the credits. Once we're done with the balance sheet, we would prepare the statement of cash flows. Let me bring that to front so we can look at that. I'll slide this over so you can see it. So now if we focus here on the statement of cash flows, you see that the statement of cash flows tells us what happens to cash during the period. It separates the changes in cash into three categories. What cash flow resulted from operating activities, what cash flows resulted from investing activities, and what cash flows resulted from financing activities. Then we calculate the total change from all three. We add it to the beginning in cash to compute our ending cash balance, and that ending cash balance is the same cash balance that we saw here on the balance sheet. Okay, and I know it's hiding behind on that statement. But again, the point of this is that we prepare all the financial statements. Now I'm going to put these back in the original order they were in. I think that looks like it right there. So the income statement to the statement of stockholders' equity to the balance sheet to the statement of cash flow. And those are the four primary financial statements that need to be prepared for external users. Okay, then we move on to step 9. In step 9, we're concerned with the closing process. And here we transfer the balances from temporary accounts. And the temporary accounts are the revenues and expenses. We may use a dividends declared account, which is a temporary account that doesn't appear on the income statement. It's not a revenue and expense, and we may have to close that out too. So here's an example of the four typical closing entries we would have. We would close out revenue to a temporary account called income summary. Now normally revenues have a credit balance, so we close them out by debiting them, which brings the balance to 0 and then transfers the balance to income summary. Then the next entry is we close out our expenses. Expenses normally have a debit balance, so we're crediting them. And we credit every expense we have. In this example, I only have 3, but in a real business, we would certainly have more than 3 expense categories that we're tracking. And we would credit them, bringing their balance to 0, transferring it to the income summary account. At this point, the income summary is holding all the credits and debits from the income statement, so if it has a credit balance, we know we had income. If it has a debit balance, we know we had a net loss for the period. But we still have to close out income summary to retained earnings. So we will debit income summary. In our example, it had a credit balance. That brings the income summary balance to 0 now, and we transfer it to retained earnings. Now in this example, I'm using a corporation as an example. If it was a sole proprietorship, we would be transferring it to the owner's capital account. And then the last closing entry we would have to make if we've had distributions to the owners. In a corporation, we call those dividends, and we used a temporary account called dividends. Sometimes it's called dividends declared. It would have a debit balance, so to close it out, we credit it and then transfer that balance to retained earnings. Now again, if this were a sole proprietorship, this account would be called drawings or withdrawals, and it's a contra stockholders equity account. That means it has a balance that's opposite of what you'd expect. Normally stockholders equity accounts have a credit balance. Dividends or withdrawals both are considered a contra stockholders equity account or contra equity account. They have a debit balance, so we have to close them out by crediting them for the dollar amount of whatever balance we had and transferring that balance to retained earnings. So here's our 4 typical closing entries. And then finally we make our way to the last step, which is the post-closing trial balance. That's the final trial balance that we prepare after the closing entries are made. Now, a post-closing trial balance no longer has revenues and expense accounts listed. That's because we've closed them out. And we've closed them out in our sample company to retained earnings. Again, if this were a sole proprietorship, it would be closed out to the owner's capital account. If it was a partnership, it would be closed out to each partner's capital account. But in this example, I've used a corporation as an example, so the closing out of revenues and expenses made their way to retained earnings. And as always, the debits always equal the credits. The post-closing trial balance is somewhat of a check to make sure that everything closed out correctly and we're still in balance. But it is the last step of the accounting cycle. Alright, so again, an overview. There's 10 steps of the accounting cycle. We identify the transactions, we analyze them, we journalize the entries, we post to the ledger, we prepare a trial balance, then we prepare adjusting entries. At that point, we can prepare an adjusting trial balance. We use the adjusting trial balance to prepare financial statements. Then we'll close out the revenues and expenses and prepare a post-closing trial balance. So I hope you found this brief presentation on the accounting cycle helpful to you.